This is an example of the 3 different depreciation methods being illustrated. We're going to use the basic data for all 3 methods. Cost of the truck, $13,000. The expected salvage value is $1,000. The estimated useful life in years is $5,000. And the estimated useful life in miles is $100,000. The first method that we will illustrate is straight line method. So the straight line method formula is cost minus salvage divided by the estimated useful life in years equals annual depreciation. So our cost is $13,000 minus $1,000 divided by 5 gives us annual depreciation expense of $2,400. And that will be our depreciation for each year. If we had not purchased this on January 1, but let's say we purchased it May 1st, on May Day, then we would have to allocate this annual depreciation for 8 months, because we would have had it for May, June, July, August, September, October, November, December. So that's 8 months. So we would take the 2,400, times it by 8/12, and the depreciation for that year would be 1,600. And then 2013, we would have had it for the entire year, so it would be 2,400. Which means that the very last year, the 5th year, or basically would be into the 6th calendar year, you would have to pick up that extra 800, which is 4 months worth of depreciation. Another thing to note is that the book value is going to change every year. The book value is cost minus the accumulated depreciation. So at the end of year 1, your cost is $13,000, and you would have had 1 year of depreciation. So your book value would be $10,600. At the end of year 2, still have your same cost, but now your depreciation is $4,800. So your book value is $8,200. The end of year 3, your accumulated depreciation is $7,200. So $13,000 minus $7,200, book value is $5,800. The end of year 4, cost minus accumulated depreciation of $9,600. Notice your accumulated depreciation is going up by $2,400 every year. So that gives you a book value of $3,400. And then in year 5, your cost minus your accumulated depreciation of $12,000 gives you a book value that is $1,000, and that is equal to your salvage value, which is what you had decided, that was your original estimate. The next method that we're going to look at is the units of activity, also known as units of production method. The formula is cost minus salvage divided by the estimated total units of activity, and that will give you the depreciable cost per unit. You then take this depreciable cost per unit and you times it by the actual units of activity during the year to get the annual depreciation expense. Once you have this depreciable cost per unit, you do not change it. The only thing that changes is the actual units of activity during the year. So our cost is $13,000 minus salvage value of $1,000 divided by the total estimated miles that we're planning to drive, which is 100,000. So that gives us 12 cents per mile. So the first year, let's say we drove we're going to take 12 cents times the actual miles that we drove. And if we drove 15,000 miles, then our depreciation expense is going to be $1,800. Let's look at year 2, 12 cents times, let's say we drove 30,000. And the amount of miles driven will always have to be given to you, at least in these problems. So if we drove 30,000, then the annual depreciation is 3,600. Year 3, let's say we drove 20,000 miles. 12 times 20,000 is $2,400. Year 4, we drove 25,000 miles, and that's going to be 3,000 of depreciation. And year 5, we drove 10,000 miles, and that's going to equal 1,200. When you add all of these up, they add up to a total of 12,000, which is the total depreciation that we have taken. Now, if we had driven more than 10,000 miles in year 5, we would just have to stop depreciating after 10,000, because remember, depreciation is an allocation of cost, and the cost that we're allocating is 12,000. So the fact that we get more miles out of it doesn't mean that we have any more cost to allocate. So, even if we had driven 12,000 miles in year 5, the most we could depreciate is 1,200. So let's just look at what our statements would look like at the end of the year. At the end of the first year, our accumulated depreciation is $1,800, and the book value, remember, is cost of $13,000 minus $1,800. So our book value is $200. The accumulated depreciation at the end of the second year is $5,400. So cost minus our accumulated depreciation, $7,600. Third year, accumulated depreciation is $78. So our book value is $5,200. Cost, the accumulated depreciation at the end of the fourth year is $10,800. So our book value is $2,200. Remember, that is the $13,000 minus our accumulated depreciation. The end of the fifth year, accumulated depreciation is $12,000. $13,000 minus $12,000 gives us an ending book value of $1,000. Now remember, the book value does not say what it is worth. It does not mean this is what it's worth. In order to know what this truck is worth at the end of year 1, we would have to have it appraised, and it most assuredly would not be the same as the book value. The book value basically says this is what cost we have yet to expense. We paid $13,000 for it. We've expensed $18,000. We could expense $11,200. Of course, we're not going to expense all of that. We're going to only expense $10,200 more because we want to leave a salvage value of $1,000. All right, the last and third method is the declining balance method. The formula for this is 2 times the straight line rate times cost minus accumulated depreciation, which is also known as book value. So you can think of that whichever way you want. Now, how do you get the straight line rate? Well, an easy way to calculate it is just take 1 divided by the estimated useful life. So in our first example, or the example that we're working with here, it would be 2 times 1 divided by 5, which is 20%. So our straight line rate would equal 40%. Another way to look at it is if you're depreciating this truck over 5 years, that's 20% a year. And now we're just doubling it, because this is called the double declining balance method. So by timesing it by 2, we're doubling it. So year 1, formula is going to be 2 times the straight line rate, so 40%, times our cost of $13,000 minus accumulated depreciation, which at this point is 0. So our our depreciation expense is going to be $5,200. So at the end of the first year, our accumulated depreciation is $5,200, and the book value is $13,000 minus $5,200, or $7,800. So year 2, 40% times our cost minus our accumulated depreciation, which is the book value, $7,800, and I could put that in there, but I'm just being consistent with the formula, is going to give us depreciation expense of $3,120. So my accumulated depreciation at the end of year 2 is the $5,200 plus the $3,120 that we just depreciated. So it's $8,320, and my book value then is $13,000 minus $8,320, which is $4,680. Year 3, 40% times $13,000 minus my accumulated depreciation of $8,320. Now I want to be clear, a common error that students make is instead of subtracting the accumulated depreciation, they subtract just the previous year's depreciation expense. So don't do that. It's the sum of depreciation taken to date. So when we do that, our depreciation is $1,872. Our total accumulated depreciation at the end of year 3 is $10,192, and our book value is $2,808. Year 4, 40% times $13,000 minus our accumulated depreciation of $10192 equals $1,123. So my accumulated depreciation is the $10,192 plus the $1,123, which is $11,315. That gives me a book value of $1,685. Okay, year 5, 40% times $13,000 minus my accumulated depreciation of $11,315. If you multiply this out, it actually equals $674. But I'll make a note here. But we have to depreciate $685 so that we end up with a book value of $1,000. So I'm going to cross that off, and we're going to depreciate $685. So our accumulated depreciation is $12,000, and our book value is $1,000. Now sometimes it's the opposite, meaning your depreciation expense that final year is more than what you can take, because if you take the full amount, it'll drop you below your salvage value. So you have to keep an eye and make on your book value and make sure that it doesn't drop below your salvage value. It should equal your salvage value at the end of the useful life. Okay, let's look at what happens when you revise the depreciation. This comes into play when one or both of your estimates changes. So in this example, for this truck, at the end of year 3, the total estimated useful life is changed to 6 years, or another way of saying it would be there's 3 years remaining instead of just 2. And at the same time, we're going to change our salvage value from 1,000 to 200, or to 2,200. Now, a key thing to remember is you do not go back and change any previous year's depreciation, but you go forward and you have to determine first how much, what's the book value at the time that you decide to change, because that is what you're going to be working with as far as your depreciation expense. So we're going to do this revision based on straight line. So if you look at when we did our straight line method, at the end of year 3, our book value, I guess I should write this down. Our book value was $5,800. So we're going to take our book value, let's see, at end of year 3, and which is 5,800 minus our salvage value. And this is our revised salvage value, 2,200. So the cost that we have remaining to depreciate is 3,600. Okay, so we've got to spread this over the remaining useful life. So we can divide this by, I'm just going to divide it by 3 years. That's what we've got left. So that is $1,200 a year for the last 3 years. And that is what you do with revising depreciation. Okay, they were originally depreciating this straight line. The estimated useful life was estimated to be 5 years. And the salvage value was estimated to be $10,000. Okay, so what we have to do is figure out what is the accumulated depreciation to date. So if you take your cost minus salvage divided by your estimated useful life of 5 years, you get 60,000 cost minus 10,000 salvage divided by 5. Your depreciation expense is 10,000 a year. So they are going to sell this on, well, let's go back. They purchased this on January 1st of 08. So we've got 4 years worth of depreciation, 08, 9, 10, and 11. 4 full years. So the accumulated depreciation at the beginning of 2012 was 4 years times the 10,000, or 40,000. Now, a lot of companies will just depreciate once a year at the end of the year. So the last time this was depreciated was December 31st of 2011. So whenever you sell something, you've got to bring the depreciation up to date. And so we need to calculate what was the depreciation for the first 6 months of 2012. So that's just going to be the 10,000 times 6/12, because it's July through December, or $5,000. That is the depreciation expense for 2012. So we'll make that journal entry first. We will debit depreciation expense for 5,000, and actually this journal entry will be 7/1/12, and we will credit accumulated depreciation for $5,000. Okay, now we need to calculate the gain or the loss on this particular asset. And the way to do that is you take the sales price, which is $16,000, minus the book value at the date of sale. Okay, well, what is the book value? Remember, book value is cost minus accumulated depreciation. Well, our cost is $60,000, but and our accumulated depreciation is the $40,000 plus the $5,000, so $45,000. And if we did a little T account here, we'll put our cost in here at $60,000, and our accumulated depreciation, it was 40, and we just added another 5, so it is 45,000. So the book value is 60 minus 45 is 15,000. So we have a gain of 1,000. Woohoo! All right, so let's journalize this. So on 7/1/12, we're going to debit cash for $16,000. We also need to debit the accumulated depreciation of $4,500. Whenever you sell an asset, you have to also, you're going to get rid of the asset off your books, and you also have to get rid of the accumulated depreciation that goes with it. Now we're going to credit our furniture for $60,000 because that is what we paid for it, so that's what we've got to credit it for. And then we will have a credit to gain on sale of furniture. Now, if our book value had been less or greater than the sale price, we would have had a loss. And the only thing that would be different is, instead of crediting a gain, we would have debited a loss. And that's the only difference between a gain or a loss. Okay, natural resources. We need to calculate depletion on natural resources. Whereas plant assets, the expense is called depreciation. For natural resources, the expense is called depletion expense. The formula is similar to actually it's identical to the units of production or units of activity method, except we call it depletion. So it's total cost minus salvage divided by the estimated units, and that's going to give you the depletion cost per unit. And then we're going to times that by the actual number of units that we take out of the ground. So, Oneness Coal Company pays $5 million for a coal mine. They estimate no salvage value, and they also estimate that they're going to get 10 million tons of coal. So we would take our $5 million cost minus 0 salvage value and divide it by 10 million tons of coal. So we figure it's 50 cents of depletion per ton of coal. So year 1, we're going to take our 50 cents, and the actual activity is 800,000 tons of coal. So that's going to give us $400,000 of depletion expense. And this assumes that all of the coal that was mined was sold. Because remember, when you mine coal, it's like inventory. If you don't sell it all, then the portion that you don't sell is going to go into inventory, and then when you do sell it, you'll take it out of inventory and debit depletion expense. You won't debit cost of goods sold, you'll debit depletion expense. So year 2, let's say we mine 900 tons, so that's going to be 450,000, and it just continues. The journal entry in year 1, you're going to debit depletion expense for 400,000, and you're going to credit accumulated depletion for 400,000. Year 2, you'll debit depletion expense for 450,000, and you'll credit accumulated depletion for 450,000. Now, some companies don't credit accumulated depletion. Instead, they will credit the actual account, the coal mine account. So I'm going to back up and show you what this would look like. When they purchased the coal mine, the journal entry would have been a debit to coal mine for $5 million. And let's say that they were really loaded, and so they made the whole purchase in cash. Okay, so instead of, the alternate way of working with your journal entry is, instead of crediting accumulated depletion, you would credit the coal mine. So the alternate depletion journal entry for year 1 would be debit depletion expense for 400,000 and credit the coal mine for 400,000. So you don't have an accumulated depletion account in that case.